RateScope here. BlackRock just quietly moved trillions of dollars, and almost nobody is talking about it. I'm not talking about rumors, opinions, or scary headlines. I'm talking about trillions of real cash being shifted right under our noses, and this specific move signals the start of a massive wealth transfer. In this video, I'm going to show you exactly where that money is going, why it's happening right now, and how regular investors like you and me can position ourselves before this shift becomes obvious to the rest of the world. Because right now, three major shifts are happening in the global economy. To help you catch them, I'm going to break down three specific ETFs and one global rotation strategy that most people won't even notice until the opportunity is already gone. We need to understand the scale of what we're dealing with. We're talking about $14 trillion in assets under management. BlackRock isn't a hedge fund with a hunch. They're the largest asset manager on the planet. If the stock market is an apartment building, BlackRock is the landlord. They own a piece of almost everything. They're in your 401k. They're in your pension. They're everywhere. So when BlackRock decides to relocate capital, they're not guessing. Larry Fink knows a whole lot more than we do. This move isn't based on emotion. It's based on math, policy, and probability. Here's the reality. Recently, BlackRock shifted about $2 trillion of exposure out of the United States and moved it toward non-US emerging markets. That's right, they took roughly $2 trillion out of the American market. Take a breath. That does not mean America collapses tomorrow, but it does mean returns are rotating. Money flows like water. It always goes where it can grow the fastest. Retail investors, that's us, react to headlines. We see the news, we get scared and sell, or we get excited and buy. We are reactive. Institutions move before the headlines are even written. They can do this because they have armies of analysts and data sets that cost millions of dollars. But here's the cheat code. We don't need their data. We just have to watch their hands. Watch what they do, not what they say. It's not hard for BlackRock to move $2 trillion. But if you don't know that money is moving, you're flying blind. By the time CNBC or Bloomberg explains the trend, it's already crowded and most of the profit is gone. So the question isn't, is the US market bad? The real question is, where is the new growth coming from next? Markets don't reward loyalty. They don't care if you love American stocks. Markets reward positioning. That's why the three ETFs I'm about to show you are so important. But before we get to the tickers, you need to understand the math behind this. By the time CNBC or Bloomberg explains the trend, it's already crowded and most of the profit is gone. So the question isn't, is the US market bad? The real question is, where is the new growth coming from next? Markets don't reward loyalty. They don't care if you love American stocks. Markets reward positioning. That's why the three ETFs I'm about to show you are so important. But before we get to the tickers, you need to understand the math behind this. Last year, the US dollar lost a significant chunk of its value. That means your purchasing power went down. Even if your stock portfolio stayed flat, you actually lost money because your dollars buy less. Investors hate that. They want to protect their buying power, so they look for assets that give them the best return for each dollar, no matter where those assets live on a map. Look at the scoreboard from last year. Rough examples. Germany's market returned around 22%. Japan's market returned around 26%. International markets as a whole were close to 30%. The S&P 500 did roughly 16%. 16% is good. We like positive returns. But when you look outside America, you realize you might be leaving money on the table. Here's the secret sauce. When the US dollar is weak, foreign assets get a tailwind. It's like running a race with the wind at your back. You move faster without more effort. When you invest in foreign markets during a weak dollar cycle, you don't just earn from the stock price going up, you also earn because the foreign currency strengthens against the dollar. That's a double return. You win twice. This is not about abandoning American stocks. Don't go and sell your entire portfolio. That's not what I'm saying. This is about diversification and recognizing that leadership in global growth is rotating. America will still innovate. We'll still dominate tech, defense, and AI. But capital doesn't care about past glory, it cares about future speed. And right now, money is looking for a new home, safer, faster growing pockets. Think about politics. You have Donald Trump, a wild card to markets. This isn't about ideology, it's about uncertainty, and markets hate uncertainty. That fear pushes money out the door. It goes where growth is accelerating, not where it already happened. We've got a perfect storm. Policy risk, currency pressure, massive amounts of cash quietly leaving. Last year alone, about $48 billion of foreign money left the US. They packed their bags and walked. So where did they go? And more importantly, where should you go? Here's the problem most of you face. You know you need to diversify and want to capture explosive gains overseas, but you don't know which country to pick. If you pick wrong, you lose. I'm going to solve that with a simple basket approach. ETF number 1, VWO, Vanguard FTSE Emerging Markets. ETF. VWO is your passport to emerging markets. It gives you exposure to China, India, Brazil, Taiwan, and more. Why does this matter? Demographics. These countries have younger populations. Young people work, spend, build, and innovate. In the US, the population is aging. In many emerging markets, the workforce is just getting started. Recently, VWO posted around 25% returns in a strong year. This year, price action is calmer. For smart investors, calm is good. Institutions don't chase charts that go vertical. They accumulate when things are quiet. Buying VWO today is a bit like buying the US market 20 years ago. It's not a quick trade. It's long-term exposure to the next global engines of growth. ETF number 2, EWJ, iShares MSCI Japan ETF. This one surprises people. Japan. EWJ has had a huge run, with strong double-digit returns recently and around 24% last year. A lot of people still think Japan is dead, stagnant, done. That's the old Japan. The new Japan is going through a structural reset, fixing corporate governance, focusing on efficiency, prioritizing shareholder returns. That means actually caring about making money for investors. On top of that, the yen is weak, which makes Japanese exports cheap for the rest of the world. That's a profit engine for Japanese companies. Institutions love this setup. Stable government, major global brands like Toyota and Sony, and a currency tailwind. This isn't a simple comeback story. It's a reset of how Japanese companies operate. ETF number 3, EM, Broad Emerging Markets. Maybe you don't want to bet on one country. You want the whole buffet. That's where a Broad Emerging Markets ETF, often labeled EM or EEM, comes in. It recently returned roughly 34% in a strong year. This is the tool institutions use when they want to make a macro bet, not just on Brazil or India, but that the entire non-US world grows faster than the US. Right now, places like India and Singapore are growing very fast. If you believe global growth is about to outpace the US, this is where you get broad exposure and spread your risk. Now, let's talk psychology. When you see headlines about sell-offs, tariffs, Trump buying Greenland, drama at Davos, do not panic and start smashing the sell button. People panic, institutions reposition, money never really leaves markets. It just moves tables, from table A to table B. Pullbacks are big players moving their chips to a new game. Here's the golden rule you need to write down. Every global rotation feels uncomfortable before it feels obvious. It always feels scary right before it becomes obvious to everyone. The trap? Most investors wait for certainty. They want the all clear. But certainty is the most expensive thing in the world. By the time everything feels safe, the returns are gone. You're buying after the big move. BlackRock isn't predicting the future with a crystal ball. Larry Fink doesn't have time travel. He has probabilities. Meanwhile, many retail investors are waiting for the news to say everything is okay, which usually means they're late. Does this mean you should sell all your American stocks? No. This isn't about fear. It's about awareness. You don't abandon the US. You find the right pockets, defense stocks, rare earth and strategic commodities, industrials and critical infrastructure. Those can act as safe harbors. But ignoring a global rotation when the largest asset manager on Earth is moving trillions, that's the real risk. You don't need to predict the future. You just need to follow the footprints in the sand. Position early, stay patient, and let the system work. Now, there's another shift happening in the shadows: gold and silver. Recently, gold, and to some extent silver, has been effectively reclassified in the banking system. For decades, banks treated gold like a shiny pet rock. Nice to have, but not very useful on the balance sheet. Now gold is being treated much closer to a Tier 1, high-quality liquid asset. In plain English, big banks can now count gold almost like cash. They can use it as collateral to borrow and leverage more money. Before, they couldn't do that to this extent. Suddenly, gold isn't just a safety net, it's a financial weapon. And what happens when big banks realize they can use gold to pull more liquidity? They buy more gold. That's one reason we're seeing all-time highs. It's not just fear, it's utility. And remember, BlackRock is in your 401k. These changes in how gold is treated impact the value of your retirement, even if you've never bought a single gold bar. This is how the game is played. They change definitions, move assets, and rarely send you a memo. So how do we stay calm when the world looks crazy? You have to understand the panic playbook. We've seen this movie before. Bad news often drops on weekends, when markets are closed. You sit at home for 48 hours, scrolling scary headlines, stewing in anxiety. By Monday, you're terrified and you sell. Then, Monday, the dip happens, weak hands fold. Tuesday, the EU says, we'll respond. The US says, try me, it feels like war. Wednesday, Thursday, rumors of constructive talks. Markets rally, the crisis evaporates. The institutions that bought your panic sale shares on Monday are laughing by Friday. It's a game played on your emotions. They keep the details vague on purpose. No specifics, just headlines and uncertainty. If you know the playbook, you don't have to be the victim. You can be the one who profits. The market is designed to emotionally hijack you. The flashing numbers, breaking news banners, all built to keep you overstimulated. I don't want you to open your account, see red, feel your heart race, and then sell everything just to stop the pain. That's exactly what the system wants. That's how wealth transfers from your pocket to theirs. You have to resist that urge to react. Settle down. Close the app. Take a breath. Do the homework. Come back when you're focused, not fearful. Knowing not to panic is half the battle. The other half is knowing what to own when everyone else is paralyzed. I mentioned a specific sector that thrives on global chaos. It's not tech, and it's not real estate. Historically, this sector outperforms the S&P 500 by double digits when geopolitical tension is high, and institutions are pouring billions into it right now. I broke down the top 3 stocks in that sector in another video. The setup is strong, and the window to get in early is closing fast. Click that video next and I'll walk you through the ticker symbols. Until then, remember, follow the flows, not the headlines. Diversify intelligently. Don't let markets weaponize your emotions. Invest with logic, not hype. RateScope out.